As the rain begins to fall in Park Ridge, allow me to address a few questions that I've gotten regarding ratios. Let me share with you what I call Professor Al's patented approach to financial ratios, and it's a basic 6-step system that I use for taking data, making it meaningful, and then converting it into actionable. So, using the example from chapter 2, I think number 8, the first step that I always deal with is asking, what is the formula? So let's pretend we are using return on equity. Well, the formula for return on equity, as we can see, is E11, which is earnings after tax, divided by the sum of E35 and E36, which are the two equity components on the balance sheet. So the basic formula is earnings after tax divided by the sum of retained earnings plus common stock. The next thing you say is, well, where do I get those inputs? Well, as we look back over here, earnings after tax is actually an income statement item, whereas the equity items are both found on the balance sheet. So you need access to two different sheets to make that happen. So now, what are the values? For example, if we look at our calculations, we see that they've been 30.9, 28.6, and then just look at the last 2 years, 24-ish and 17-ish%. Well, now we have numbers, but what do those numbers mean? So number 4, this is kind of my patented way of thinking about what ratios are, which is to say, for every one denominator, in this case, the denominator is retained earnings plus common stock, so we could name that dollars belonging to investors. How much? Numerator. In this case, the numerator is earnings after tax, or profit. So return on equity can really be thought about if I, as an organization, am maintaining investors' money through the sale of common stock, through the retention of their profits, how much new profit do I create for them, or the return to their equity investment? So now I can ask, well, how does that compare? Well, if I look at these, I can see that those have been steadily declining over time. That's what you would call a horizontal or linear analysis. Versus, you could do a comparative analysis. If we had data for other firms that were similar to R&E Supplies, we could see whether or not our 24 and 16% of recent compared favorably or disfavorably against other firms, so we could benchmark ourselves not just against history, but against trends in other firms in our industry. But lastly, the biggest benefit to the reason that we do these types of analyses is to ask ourselves, well, what next? What can you actually do with this information? And the idea then is to convert this information into something that can be executed. And this is the beauty of it. It's basic in so much as all you need to do if you want the number to increase is increase the numerator or decrease the denominator. So for example, an operational strategy could be to increase the numerator, earnings after tax, aka profit, by decreasing costs, like reductions in a labor force. Or we could use a financial strategy that looks at the denominator, so dollars belonging to investors. If we need the ratio value to be higher, we need to decrease the denominator. So how do we get less retained earnings or less common stock? Well, one of the things we could do would be to decrease common stock by repurchasing shares. So those are the ways you can take data from financial reports, put them into formulas, analyze them over time in comparables, and correlate them into positive executable strategies for organizations.